Okay, I've come your way once again, and thank you for clicking on this video. And I pray that and I wish that by the end of this, you will get the clear understanding. I'm redoing this video because many of you complained about the sound that was in the previous video, and that was because of the background sound. So it didn't really bring clarity when I was trying to explain one or two things. So you will do it fast because with this one, the most important thing is the explanation. Yeah, since we've already watched the previous video to know how the formulas are being inserted. So last time or previously, we did how to design the worksheet. So if you have not watched that, you can go back to our previous video to watch how to design our worksheet. And then again, we have first done this. We have first done this, and then we are going for the second one. So how to compute all these things have already been done in the previous video. So you can kindly go back and revisit it. Let's master this thing before class resumes. Now, we are in this session, which is the second sheet. So on the second sheet, what we are going to do is to find out some one or two things. One is we would like to know the monthly payment, and we would also be looking for insurance payment. That is, when we say insurance, what it means is, let's say it's a it's a way of managing risk, that people have come for a mortgage, or let's say a loan, and you've insured the loan, that in case these people don't pay the loan, the insurance company, you go and claim the insurance. So normally it's based on a condition. And this one, it's you, the one who went for the loan, who will be paying it. So now on this sheet we have the input data normally. So we have the dates. As we know, the formula for dates is today, and then you bring bracket open and close to get today's date, and today's date is 18th. And you come to the payment per year. It's given, we are paying 12 times in a year, and the payments, the PMI rate, that is the insurance rate, is 0.38%, and then the down payment rate is 20%. So they are trying to tell us that anybody who takes a loan should make a minimum down payment of 20%. If the person do not pay a minimum of 20%, then the person have to pay insurance. He should pay extra, and that is the way of reinsuring it. So that if in case, because you couldn't meet the 20%, if in case you're not able to pay, because this 20% is not just something that they are saying, it's something that they have calculated to know that if the person is able to pay 20%, maybe it means the person has a financial capability to maybe pay the loan. And then we have this rate here that is based on the number of years. So you will first start with the amount finance. Normally we know the formula. The amount finance is we deducting the down payment from the house cost, or the actual cost of the loan. So this is the amount finance. We know how to change the Ghana cedi sign already. So if not, then you need to go back and then check it out. The down payment percentage have been given, but in an instance where it's not given, you can calculate it. That is the down payment over the house cost, and then you get the down payment percentage. After that, you come to the number of payment period, and the number of payment period here, we are trying to find out how many times the person will be paying the loan. We've been told that the person will be paying it 12 times per year, and then here the person will be paying it within 25 years. So mathematically, we are multiplying this by this, and then we know that this person will come to our office, or there will be will be paying the number of times. I hope you get it. So the formula, as usual, it's equal sign, and you select the number of years. If you know the cell number, it's simple to just type or key in F9, and then you are good to go. This F9 is not great. So just key in F9 and you multiply by the total number of years, which is not a relative cell, so you make sure that you lock it, or you make it absolute. After that, you key the enter, or you just accept the formula and then you drag it. So it means this loan number 392786, we will be paying 300 times. This one will be paying 360 times. This one will be paying 300 times. This one will be paying 180 times. And this one will be paying 360 times. So these are the number of periods that we will be paying. Now we come to the monthly payment. As I have already said in the previous video, the monthly payment has a formula in Excel called the PMT formula. So whenever you hear that we are paying something monthly, you use the PMT formula. So the PMT formula is equal to PMT, and then you select it, and then your bracket is open. Now, the next thing that we are doing here is the rate. So we are asking that what rate should we use? What rate are we using to make the payment? Now we have this payment, which is the APR rate. So this is the payment per annum. This is the payment per annum. And then so the PMT rate, you go for the rate. I think there's something that you should have created here, so let's do that one before. I think there's this one, so let's delete this one. This one too will not be given, so let's do the APR rate. Let's do the APR rate. So the APR rate is not given in this this sheet. It wasn't given. I think I forgot to delete that one. So the APR 2 is not given. So now we have done this, and then we have done this. So let's work on the APR before we come to the monthly payment. Is that okay? So to deal with the APR, unlike previous one, we were given the APR rate, that is the annual percentage rate, and then if possible you would divide it by the number of times to get the monthly percentage rate. But here it wasn't given, but we were given this table, or probably let's say a schedule. So what we would do is we have a function called a VLOOKUP. So you use the VLOOKUP table to go and look for. So what this VLOOKUP means is that we already have a table. So for our better understanding, normally some of the banks will have this sheet, just like when some of us were doing financial analysis or financial management. You see that at the back of the question paper, we would have a schedule for the discount factor. You see, so they will state up to a certain range for you, so that in case if some of the rates that you will pick is in line, you just go for the value. So sometimes the banks too have something like this, years and their rates. So maybe they are starting from 15, 20, 25, 30, 35, 40, 45, 50, up to maybe a certain number, a maximum years that they give their loans or mortgage to. So here it starts from 15 and then to 30, and this is the respective rate. So this VLOOKUP will mean that whatever you pick here, it should give you the corresponding rate. Whatever you pick here, so if it's 25 years, it will give you the corresponding rate for 25. So there wouldn't be any need for you to be computing rate by rate, since this table is already in existence. You just VLOOKUP it, and then when it go 20, it will automatically get you the corresponding rate. So you go for the VLOOKUP. Now, so the VLOOKUP value is the one that we want to choose. We want it to have effect on, and that is the years. So after the years, you bring your comma and then the table array. So the table array is from here to here, and then you lock it because it's outside our sheet. Let me put it like it's outside our table, this very table, and they are not relative. So you lock both the D and then the 4. Good. After that, you bring your comma, then you come with the call index number. So even you don't need to chew this formula in your head, just follow these ones. So we have already picked this one, which was this. We have picked the years already here. So what we need is the rate, which is in the second column. So you bring column 2, and then you are done. So as usual, you just drop it here. So if you change this one to 30, it will give you this one. And if you change it to 25, it will bring you this one. That is because whatever that you key here must be part of the ones here, so that it will give you a... Let me just try and see if 26 will work. I'm not sure. Okay, 26 also work because maybe it's in a range. Do you understand? Maybe it's also in a range. Okay, so that is it. So now let's come to the PMT formula, which we were doing previously. So now, as we have already said, monthly payment, we use the PMT formula, the PMT formula, yes. So we start with the rate. This rate that we are talking about is the monthly rate. So if you like, you can create another column here and then key in the monthly rate. That is dividing this one by 12. So that you wouldn't need to struggle much when it comes to this this formula. So let's stick with this one. You select the rate, which is here, and then you divide it by the number of times that you are paying in, which is 12. Then you lock it because it's outside. So that is 1. And then you come to the MPECH. I don't know if the number of periods were part of the requirement. I think I created it myself or something like that. So since we have the number of period here, payment here, you can just select it and then we are good to go. But in case you don't have the number of payment period, which I doubt, you can just key this 25 times the number of time, which is 12, and then you lock it. So now you've gotten the number of payment period, the payment time, and then the rates. You bring the comma. The next thing is the present value, and the present value is always the amount financed. And then you come and select the amount financed. But if you select the amount financed alone, just like that, the figure that you will get will be negative. It will be negative because we want to know how much you will be paying. That is what we want to know. But what we are doing, we are taking it from the perspective that me, like I'm the one who came for the loan. So I just want to know how much I'll be paying. But since it is a deduction, since you are paying, so you are deducting, it will be negative if you select the number just like that. So we were advised to bring the negative sign so that again we'll make it poor. And you select the finance amount. And then this is it. So this is it. So this is the amount that you'll be paying per month. This is the amount that you'll be paying per month. And then nextly, we go for the monthly payment, insurance payment. So what does this mean? I've already explained that one from the beginning of this video when we were talking about the PMI rate, which is 0.38. What it means is that we are saying if the person who came for the loan is paying a down payment more than 20%, then the person will not pay any insurance. But if the person is paying less, then we will charge the person an insurance of 0.38%. 0.38%. I'm sure this is understood. So we are only charging those who will pay less than those who pay less than what? Who pay less than 20% payment down. So if you pay less than 20% payment down, which it has been stated in B7, then it means that you have to pay this 0.3 um 0.38%. So we are using the if you pay more than, then you are zero. But if you pay less than, then you pay. So the if can be beginning or the end, it doesn't matter. So you can start with if then you bring your bracket. So if this one, this is the percentage. If this one is, should we start with less than or should we start with greater than? Let's start with less than. I prefer to start with less than. If this is less than or equal to this, which is the 20%, and we locked it, then if it is less, then it is this rate which we lock it times the amount financed. It's always on the amount financed. But if it is not, then it's zero. You're done. Then it's zero. So this one was 20%, so it's zero. This one is 20%, it's zero. But this one was 15%, so they will pay insurance. This one, they will pay insurance. This one, it's zero. So this is a fast version, right? I'm sure we got everything clear. We will meet. I'll do the next video and upload it on the car loan, the two of them, both variables, and then we can watch them before we meet class. Thank you and God bless you. I want you to respectfully subscribe, like the video. The more you do that, just as I said, it will encourage me. It will encourage me to do more. I think that we are having about 6 something like that. 6 subscribers. We want more, so that it will also ginger me to do more. Thank you very much for watching.